Today, folks, we need to talk about this high-yield Canadian dividend stock that recently just tanked on its earnings and, dare I say, is the lifeblood. It is the infrastructure that powers the entire Western world. If this company disappeared tomorrow, guys, we would collapse as a society. That is no joke as we break down basically Enbridge stock. Now, this is one of the greatest Canadian dividend stocks that is one of the largest positions in my portfolio because of its weighting in VDY, my high-yield monthly paying Canadian dividend ETF. So we need to break down, is this a buy? We will listen to the CEO. We will break down the earnings and give you a kind of clear view on why it's likely the stock is dropping. So if you are on a path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe. We all looking to produce those juicy dividends. And on that note, I would never buy this as a growth stock. It is not a growth stock. It is an infrastructure play. It is, a profound piece of infrastructure to society. And it recently tried to tap its all-time highs, but couldn't quite get there. And now is tanking. And this is only a stock you want to see tank. When it goes down, the yield goes up. And this company is a very reliable yield. And you should buy it when it gets extended to the upper end, because that's where your total return is going to come from. And I do not recommend looking at companies specifically like this unless you really want that dividend income, because again, it's a company that over time is historically paying a yield that we're not used to seeing because it has been flatlining for so long, and it's a company that has been increasing it, but those dividend increases are starting to slow down. I mean, it almost doubled it over the last decade, but if we take a look at the dividend scorecard itself, its 5-year growth rate is only 4%. I'm very confident, though, with the recent acquisitions, the natural gas that they purchased, the utilities that they bought in the United States will help continue to grow revenue as they kind of clean up the bottom line. But this was one of the greatest earnings I've seen, and I don't think these articles justify it. Motley Fool released, is this a buy, sell, or hold, saying that basically if you look, the company's revenue increased just 6% in the trailing 12 months, although its EPS did pop by 95% over the last 5 years. It's compounded its revenue, earnings, and book value by the following rates: revenue minus 0.3%, earnings 0.3%, book value minus 5%. But I don't like to look over the last 5 or 10 year period, because now we are in a new exceptional period for the company, and I think it's going to continue to reflect in its upcoming earnings. So if we look at the high profit, this company's been crushing lately on its capital expenditures, making gross margins at 48%, operating margins almost 20%. I mean, free cash flow is up 7.9% here, or at 7.9, return on equity 10%. Yeah, it's got a wicked high yield, but people are saying it's not exactly a bargain. I will say this company usually doesn't trade at a deep discount, and it doesn't usually trade at an overextended value either. It usually trades in line with what I think the market would define as fair value. So you need to kind of get market shocks where we kind of go into black swans, something like the pandemic, something like the 2022 crash, and you need to get a little bit more aggressive, because again, I think you should lock in the yield and expect the yield to be your total return. And this is a buy and hold forever company, and I cost average into it through VDI till I motherfucking die, baby. The VDY, my high yield monthly paying Canadian dividend ETF, where Enbridge is weighted at 8.8%. I would rather focus on owning the greatest Canadian dividend stocks through this ETF, because it is a very simple way for me to cost average, and it is an ETF that not only offers capital growth over time, but a great increasing dividend yield that I can collect monthly. Now, this is similar to the S&P TSX because most Canadian companies pay high yields, right? Almost all our biggest companies pay great yields, but you're not going to get the growth stocks, your tech stocks like, say, Shopify or Constellation Software in here, but I get my growth exposure through the United States, and I want to hold this as a mitigated way to get exposure to the Canadian economy and help supplement some of my income in case I go through job volatility. It also helps me take extra capital I get paid to invest elsewhere in the market, and I love that if I put $100,000 into this ETF, Enbridge will make up an $8,800 weighting, right? So I would highly recommend exposing yourself through XDIV, XEI. This is VDY. There's many great Canadian dividend ETFs out there if it's something that suits your investment philosophy or style, because I cannot tell you what to buy. I'm not a financial advisor. However, let's listen to the CEO himself. Let's get a clear view on what I think is probably one of the greatest growth potentials for them, and then we'll break down why I think the stock has dropped.
Demand for electricity. Let's talk a little bit more about data centers, because this was a topic on your earnings call as well. Basically, what are the conversations that you're having with those data center operators? How much does Enbridge stand to benefit from that?
Yeah, big time. As I said, I mean, we've got a BCF of new pipeline infrastructure, so 1 billion cubic feet of increased demand from data centers and power. So you're seeing two groups. You're seeing the likes of the Amazons and the AT&Ts who might want to actually sign up for, say, solar projects in Texas or Ohio, which we've just done with them. But they also want to have natural gas backup. You're seeing the likes of Duke Energy bring on new gas-fired generation, or the Tennessee Valley Authority, TVA, moving from coal to gas, all to serve things like data centers. So there's two places. One, right in the backyard of the data center itself, or two, big utility producers and sometimes independent power producers who are connecting to those data centers. We get the benefit of both, having solar business as well as having actually electricity business, the pipeline business as well. So yeah, it's on. I don't think it's going away anytime soon. You're going to see much bigger need for gas demand than we've seen for decades, as well as on the electricity front as well.
Probably one of the most bullish statements I've ever heard out of this CEO, which is why I keep saying don't reflect on the last 5 or 10 years. I do believe that we are in a new growth phase for this company. And at the beginning of this call, they did say that basically, how do you think tariffs could affect the company? And I think it's one of the reasons that the stock pulled back, because they have no control over tariffs. And they said, we will have to share that cost. And when he said it in that way, people, I don't think, interpreted it very well, because he was making it out like the larger oil companies, Enbridge, and the end users, people like us, will have to supplement those tariffs. But otherwise, they also talked about living in Canada right now, especially, or if you live in some parts of the northern states, I'm sure you're experiencing this absolutely absurd blizzard. As I look out my window, we have seen more snow than we've seen since I've been a child, and a lot of people lean into Enbridge for gas. In fact, if I go outside, I wouldn't be surprised if in our condo building, Enbridge is the natural gas supplier for the heat that runs this building. And because of that, obviously, we're seeing an increased demand in natural gas. This tends to go through its annual fluctuations when winter comes around. But putting that aside, guys, this company isn't just a pipeline company either. The pipeline, I think, matters the most, but we are talking about a company that's diversified into renewable energy. And we're not talking about small renewable projects. I mean, they're working with Amazon, AT&T, Toyota, multi-hundred, megawatt power generation, 850 megawatts for these companies like Toyota and AT&T. Like, these are not small projects at all. And they are diversified across the entire Western world here, guys. And if you take a look too, if I want to talk about the diversified energy offerings, again, whether it's pipeline, like you look at the gas transmission here, gas distribution, and that renewable power, this infrastructure is jaw-dropping. I mean, the pipelines alone run all the way from literally past Alberta all the way up north to literally the border of Texas here, going down toward Mexico. And this is literally what runs our entire lives. And I don't think people understand how much Americans have ownership over these companies, which is why tariffing just doesn't seem to make sense, because our companies are so integrated these days. Like, Enbridge seems like just as much as a US company as it does a Canadian company, right? So let's just talk a little bit about this. You can go take a look at the investor deck if you want to deep dive and really get a feel out for how this infrastructure is integrated. But I do want to point out that the company had record financial results again, 13% EBITDA growth, 30 consecutive years of growing the dividend, 37% total shareholder return in 2024, which of course they're going to highlight that because it's been one of the greatest years they've had in a while. They closed that $19 billion acquisition of 3 premier US natural gas utilities that I think is going to excel the company into 2025. I mean, you got to think $20 billion when this company was trading down more toward the $100 billion range. I mean, that $20 billion acquisition was literally, 20% or more of their entire market cap at the time. Not a small deal. I mean, it was massive, right? And they have over $8 billion in newly sanctioned organic growth, and they recycled over $3 billion of capital at an attractive valuation, trading at a target range of 4.5 to 5x debt to EBITDA, right? So they're on path doing one of the greatest jobs they've done in the last several years, in my opinion. Look at the EBITDA growth here. Absolutely insane. And that's what I want you to focus on, right? If you take a look at total operating revenues, they're finally hitting revenues they haven't seen since 2022. I mean, they actually hit an all-time high for revenue, and I think they're going to continue to see extended revenue growth, right? I mean, they definitely grew dramatically over 2023. I think this is going to be a new level for them, and I don't think the stock price is going to come down to the discounts that we've seen in the past, especially with the recent margin expansion. Look at the operating expenses. I mean, they're back to the same revenue they saw in 2022, but they're spending way less. I mean, almost 5 billion less than they were on total operating expense, and I think they're going to continue to see efficiencies here. So I mean, I think they did a great job at delivering, and I think they're going to continue to. And you have to keep in mind, when you look at the dividend payout ratio of 156%, you can't utilize that as a metric of understanding, because payout ratio is based off earnings per share, but earnings per share doesn't take into consideration depreciation and amortization, which is writing down the infrastructure costs, because they technically have about $5.1 billion that isn't hitting their earnings per share. Again, I think the company is sitting in the best position that they've seen in a literal decade here, or at least since 2015, right? I think people are underestimating this company, and you shouldn't be looking at the prior history. You should really just look at what's happened in the last 1 to 2 years and realize that's a trend that's likely going to continue. I wouldn't be surprised if the company cracks all-time highs, but you shouldn't be celebrating that. Again, you want to capture this when it's trading somewhere probably closer to an 8% yield. You want to lock that in, or do what I do and just cost average to an ETF. But do not, put Enbridge aside as a junk company. It is one of the greatest companies on the planet, and it will continue to be. So I'm going to pass that question off to you. However, do you like Enbridge? Is it a stock you are buying? I'd love to hear about all of it in that comment section below.